20 years from now, one of these two men will have roughly $600,000 sitting in an investment portfolio. The other will own a house worth more than $750,000, with about $550,000 of that house actually belonging to him. And here's the part that should bother you a little. The person with the bigger number is not necessarily the person who made the better decision, because one of them will spend the next 20 years paying rent, a bill that never has a final due date. The other will spend those 20 years paying interest, property tax, insurance, and repair bills on a house he can't sell one room at a time. Same income, same savings, same city. No inheritance, no lucky break, no financial head start for either of them. They start from the exact same line. One of them buys, one of them rents. And we're about to follow both of them for the next 20 years to see who actually comes out ahead and why the answer isn't as obvious as either side of this argument wants you to believe. Daniel and Marcus are both 34. Same city, same job market. $92,000 a year, each of them. $95,000 in savings, each of them. No debt worth mentioning. Financially, on day one, you could not tell them apart on paper. But personality-wise, they're nothing alike. Daniel wants stability. He wants to know what next year looks like, a place that's permanently his, a garage, a backyard, a wall he's allowed to knock down if he feels like it. He does not want to be 50 years old still wondering whether his landlord is raising the rent again this year. To Daniel, a house is housing, stability, and a long-term asset rolled into one purchase. Marcus wants the opposite: flexibility, liquidity, the ability to pack up and move cities on 6 weeks' notice if a better opportunity shows up. He does not want $95,000 locked into one property, in one neighborhood, in one city. His logic is simple. If he can rent something just as good for less than it costs to own it, why not put the difference to work somewhere else? Here's the uncomfortable truth this video has to sit with. Neither one of them is wrong. If one of them were obviously making a mistake, this would be an easy video to make. But both of them are running a strategy that can genuinely work, which is exactly what makes this worth following for the next 20 years. Daniel finds his house. $385,000. 3 bedrooms, a garage, a backyard he will become irrationally protective of within about 6 months of moving in. He puts down 20%, $77,000. Then come the closing costs, lender fees, title fees, inspections, prepaid taxes. Call it $11,500. That's $88,500 gone before he's carried a single box through the front door. He's left with about $6,500 as a cash buffer. Notice what actually happened here. Daniel didn't simply spend $95,000 on a house. He used almost all of his liquid capital as the price of entry into the real estate market. That distinction is going to matter later, so keep it in mind. His mortgage, $308,000, 30-year fixed at 6.75%. Principal and interest alone come to just under $2,000 a month. Add property tax, homeowner's insurance, and a maintenance reserve, and Daniel's true monthly cost of owning this house lands at roughly $2,868. Marcus rents a comparable place nearby for $2,150 a month. No property tax, no homeowner's insurance, and when the water heater eventually dies, and it will, we'll get there, that's not a bill with his name on it. More importantly, Marcus still has almost all of his capital sitting untouched. His full $95,000 goes straight into a broad stock market index fund, and the monthly gap between what Daniel is paying for housing and what Marcus is paying in rent, about $718, goes into that same investment every single month. There's one rule Marcus has to follow, and it's the rule that ends up deciding almost everything 20 years from now. That $718 is not allowed to quietly become a nicer car, a vacation, or a slightly upgraded lifestyle. This is capital with a job to do. It is not spending money, no matter how tempting it looks sitting in the account. Before we start the 20-year clock, we need to make this fair. Every comparison like this runs on assumptions, and pretending otherwise is exactly how these videos turn into propaganda for whichever side the creator happens to prefer. Here's our base case. Home prices appreciate 3.5% a year. The stock market returns 8% a year. Rent rises 3% a year. These are modeling assumptions, not predictions, and definitely not guarantees of anything. And because nobody actually knows what the next 20 years hold, we'll also glance at a weaker case and a stronger case. Conservative, stocks return 6%, homes appreciate 3%. Strong, stocks return 10%, homes appreciate 4%. Keep that range in the back of your mind, because depending on which version of the next 2 decades actually shows up, the final winner in this story can shift dramatically. We'll come back to that. You've probably heard someone say, at least Daniel is building equity. True,
But let's actually check how much. Daniel's mortgage payment is about $1,998 a month. In month 1, almost all of that is interest. The principal portion is only a few $100s. Add property tax, insurance, and maintenance, and Daniel's total housing spend is $2,868. Out of that entire amount, only a small sliver is actually becoming wealth. The rest is simply the cost of the roof over his head. That doesn't make homeownership a bad deal. It just means the phrase building equity is doing a lot more marketing than math in the first few years of a mortgage. Meanwhile, Marcus pays $2,150 in rent and builds zero equity. That part is entirely true, but his $95,000 is compounding from day one, and so is the $718 he's adding every single month. Stop here for a second. If you had to bet your own money right now on who's going to be ahead, who would you pick? 3 years in, Daniel's mortgage balance has dropped to about $298,000. His house, appreciating at 3.5% a year, is now worth roughly $427,000. That puts his home equity at about $129,000. Marcus's original $95,000 plus 3 years of that $718 monthly contribution compounding at 8% has grown to roughly $145,000. Marcus is ahead. If you pause the video right here, you'd probably conclude renting and investing wins outright. Hold that thought, because there's a cost sitting quietly in Marcus's corner that hasn't shown its teeth yet. Rent.
Marcus's rent started at $2,150. At 3% a year, by year 5 it's around $2,490. By year 10, about $2,780. By year 20, close to $3,880. Meanwhile, Daniel's principal and interest payment, the single biggest chunk of his housing cost, stays exactly where it started, about $1,998, forever. That is the entire point of a fixed-rate mortgage. To be clear, Daniel isn't frozen in time either. His property tax, insurance, and maintenance still climb with inflation, but one of his largest monthly costs is now permanently locked in place, while Marcus's entire housing cost keeps climbing every single year, with no ceiling in sight. This is one of the biggest turning points in the whole comparison, and it happens slowly enough that most people never notice it happening in real time. Year 5. Daniel wakes up to a cold shower and a puddle on the laundry room floor. The water heater is done. The repair bill comes in at about $1,800. Daniel, staring at the invoice, great, another $1,800. Marcus, for the record, has never once paid to replace a water heater in his life. But before you feel too sorry for Daniel, Marcus has also never built a single dollar of equity in-house. Every convenience comes with a trade-off attached to it, and this is what Daniel's trade-off looks like on a random Tuesday morning. 10 years in, this should finally settle the argument, right? Not really. Daniel's house is now worth roughly $543,000. His mortgage balance has fallen to about $270,000. Equity, around $273,000. Marcus's portfolio sits at roughly $280,000 to $290,000. Look at that. Nobody is winning decisively anymore. Marcus's number is slightly ahead, or roughly tied depending on exactly how the market behaved that decade. Daniel's equity has nearly caught all the way up. But the two piles of wealth are not the same kind of wealth. Marcus's portfolio is liquid. He can sell $20,000 of it next week if life demands it. Daniel's equity is locked inside a house. He cannot sell 8% of his living room to cover an emergency. Rewind slightly to year 7. Marcus gets offered a better job in a different city entirely. For Daniel, a move like this would mean selling a house, dealing with a buyer, paying agent commissions, timing the market, and possibly renting his old place out from a distance while praying the tenant pays on time. For Marcus, it means giving 30 days notice and signing a new lease. To Marcus, moving isn't a financial event, it's a Tuesday. To Daniel, moving could mean putting a 6-figure asset up for sale and hoping the numbers still work out in his favor. This is what flexibility actually buys you, not just a feeling, but the ability to make a career decision without a 6-month real estate process attached to it.
Let's stress test this model, because so far it's been a fairly smooth story for Marcus. What happens if the stock market drops 30% in year 12? On paper, Marcus's portfolio takes a serious hit. Meanwhile, real estate, which tends to move slower and less violently than stocks, keeps climbing at roughly the same steady pace it always has. Suddenly, for the first time in this entire story, Daniel is temporarily ahead. Not because he did anything differently, just because one asset panicked and the other one didn't. If you pause the video right here, you might think, see, buying wins. And that conclusion would be premature. Because now we hit the real test, not of the spreadsheet, but of Marcus himself. He opens his brokerage app. He watches a number that took 12 years to build shrink in front of him, and he has to decide what to do next. The model we've been running this entire time assumes Marcus stays invested no matter what. Real life requires him to actually behave like the model. He doesn't sell. It isn't easy, and it isn't automatic, but he keeps contributing that $718 every month exactly like he has for the past 12 years, straight through the downturn. Over the following few years, the market does what it has historically done after every major drop. It recovers and eventually moves past its old highs. Marcus's portfolio not only rebuilds, it ends up larger than if the crash had never happened at all, because he kept buying while prices were down. This is the part of the story that spreadsheets never show you, because a spreadsheet doesn't get scared. A person does. Year 13. Daniel's roof, now well past its prime, needs to be replaced. The bill, about $11,000. Daniel, looking at the invoice, this is exactly why people hate owning things. And also exactly why comparing a mortgage payment to a rent payment on its own was never a fair comparison to begin with. The real cost of owning a home isn't just the number on the mortgage statement. It's the mortgage plus taxes plus insurance plus every surprise bill hiding somewhere in the walls, waiting for its turn. Year 20. This should finally definitively settle it. Except it doesn't. Daniel's house is now worth roughly $765,000. His mortgage balance has fallen to about $215,000. That leaves him with home equity of roughly $550,000. Marcus's portfolio, after 2 decades of contributions, 1 brutal downturn, and a full recovery, is worth somewhere north of $600,000. On paper, Marcus wins. But we're not done. Here's the problem with stopping the clock at year 20 and calling Marcus the winner. Marcus is currently paying about $3,880 a month in rent, and next year that number goes up again. It never stops. There is no version of Marcus's future where his rent hits zero. Daniel, on the other hand, has only about 10 years left on his mortgage. After that, his $1,998 principal and interest payment disappears completely, forever. He'll still owe property tax, insurance, and maintenance, but the single largest line item on his housing bill simply vanishes. Marcus doesn't get a finish line like that, not ever. So what happens if we don't stop the story at year 20?
Fast forward another decade. Daniel's mortgage is paid off. Zero balance. The house belongs to him outright. His only ongoing housing costs now are property tax, insurance, and maintenance. Nothing else. Marcus's portfolio has kept compounding, and it's larger than it has ever been. But his rent is still there, still rising, still a permanent line item on his budget, for as long as he chooses to live somewhere that isn't his own. This is the moment you realize there's no universal winner buried anywhere in this story. If the stock market stays strong, Marcus can pull ahead and stay ahead. If home prices appreciate well, Daniel can catch up or overtake him. If rent keeps climbing faster than wages, Daniel's fixed payment becomes even more valuable in hindsight. And if Marcus had ever lost his discipline, even for a couple of years, Daniel's advantage would have shown up fast. If you're still trying to declare one final winner, here's why that's the wrong question. Net worth alone was never the whole picture. Let's look at 3 scoreboards side by side, all at year 20. On net worth, it's close. Daniel's equity around $550,000, Marcus's portfolio just over $600,000. Marcus is slightly ahead, but not by much, and not without risk along the way. On monthly housing cost, Daniel is paying roughly $2,000, largely locked in place. Marcus is paying close to $3,900 and climbing every year with no ceiling. And on financial flexibility, liquidity, mobility, how exposed each of them is to a single local market, Marcus wins comfortably. Daniel's wealth is concentrated in one house, on one street, in one city. Marcus's wealth is spread across thousands of companies and can be accessed with a few clicks. 3 scoreboards, 3 different winners, depending on what you're actually optimizing for. So, buying or renting, the honest answer isn't a winner, it's a reframe. Housing is a cost, full stop. Both of these men spent 2 decades paying for a place to live. They simply paid in different currencies. Daniel paid in interest, taxes, insurance, maintenance, opportunity cost, and illiquidity. Marcus paid in rent inflation, and the ongoing uncertainty of never owning the place he lives in. But each of them bought something the other one didn't get. Daniel bought stability, control,
and a mortgage-free home waiting for him at the finish line. Marcus bought liquidity, flexibility, and a portfolio he can access the moment life changes direction. One of them bought certainty, the other bought options. After 20 years, Daniel didn't prove that buying is smarter. Marcus didn't prove that renting is smarter. They proved something more useful than that. The house was never the entire investment, the rent was never the entire cost, and the mortgage was never the entire story. Daniel used housing to build stability and forced equity. Marcus used housing to preserve flexibility and put his capital to work somewhere else. And whether either strategy actually makes you wealthy depends entirely on what you do after making the decision, not on the decision itself. But there's one assumption Daniel and Marcus both made without ever noticing it. They both assumed they'd stay in the same city for the entire 20 years. What happens when the city itself becomes too expensive to stay in? Because sometimes the biggest financial decision isn't the house you buy, it's the place you choose to live in the first place.
Subscribe to Economics Writer for more videos breaking down the logic behind the financial decisions we make every day. And tell me in the comments, are you Team Daniel or Team Marcus?